Hi, everybody. My name is Jay Scalen, and I am a member of our investment team here at Osborne Partners and have been since 2013. And from time to time, we like to reach out and have conversations around pertinent and relevant topics to keep everybody up to date on issues that, here internally we are actively discussing as an investment team. And today we wanted to talk a little bit about diversification and specifically take a look at the traditional 60-40 portfolio, which many view as the standard of diversification. And we want to ask and answer some questions that may dig into the topic a little bit more to see if the traditional 60-40 portfolio might be a little bit more vulnerable than many expect. So the traditional 60-40 portfolio is one that is constructed of 60% equities, typically US equities, with the remaining 40% allocated to fixed income or bonds. And like I said, this has long been viewed as a prime example of diversification. But in recent months and years, the investment team at Osborne Partners has flagged various concerns, mostly around whether this portfolio construction really goes far enough to protect investors in different economic environments. So one good example of this is really what's gone on with interest rates and inflation, which, as many know, are two of the more important economic variables. Both have been relatively consistent tailwinds to the traditional two asset class 60-40 portfolio. As really, coming into this year, we've seen the combination of gradually declining interest rates alongside core inflation readings that, have really been under 3% for the vast majority of the past 20 years. Yet in the past 12 months, these variables have changed. We're now seeing much higher inflation, and we're also seeing a pretty rapid rise in interest rates. And we're also starting to see signs that the traditional 60-40 portfolio may actually be missing valuable components, specifically ones that can perform well in a higher rate and higher inflationary environment. Another primary concern of ours was valuation. This graph shows the weighted average earnings and coupon yield of the traditional 60-40 portfolio. And the easiest way to read this graph is the higher the metric is, the cheaper it is relative to history. The lower this metric is, the more expensive it is relative to history. And as you can see, at the exact same time that the economic variables that we were just talking about shifted to headwinds, the traditional 60-40 portfolio was trading at valuations that have rarely been seen over the past 20 years. And so the result of these shifting economic variables coinciding with these stretched valuations that we just talked about can be seen in this chart right here. The first quarter of 2022 would be the third worst year on record since 1980 for a traditional 60-40 portfolio. The only other 2 years that have actually logged worse performance was in 2002, when the US was just exiting a material recession, and in 2008, when, as many of you know, the US was right in the midst of the global financial crisis. So one natural question may be, what can be done to address the concerns that we have about the 60-40 portfolio? And this slide helps to provide an answer. Instead of a portfolio that simply has exposure to two asset classes, our multi-asset class approach gives our clients exposure to 7, including asset classes like real estate, alternatives, and natural resources, all of which have done well historically in the type of economic environment that we're seeing today that's characterized by higher inflation and also higher interest rates. Now, most people are pretty familiar with the roles that US equities and fixed income play in a portfolio. US equities are typically viewed as your growth assets, while fixed income typically provides income as well as capital preservation. What people may not realize is the void that is left in a portfolio by not including other asset classes, whether it's hedging inflation and interest rates via natural resources, providing attractive income and capital appreciation via real estate, or even utilizing things like dollar and interest rate hedges to preserve capital in your alternatives asset class. Excluding these asset classes actually increases the overall risk of your portfolio by exposing them to these very variables that we're looking to take advantage of through these other asset classes. So all of this may sound great, but does this actually translate into better outcomes? The chart on this slide shows our firm's interpretation of a true diversified portfolio, one that has exposure to 7 asset classes, but also has roughly 60% exposure to equities, which is consistent with your typical 60-40 portfolio. And as you can see in this in the chart on this slide, simply by including these less traditional asset classes in the portfolio, you're capturing nearly 1/2 of the downside that we've seen through the end of the first quarter in a traditional 60-40 portfolio. So to sum it up, there are different interpretations of diversification. At Osborne Partners, our belief is that a true diversified portfolio goes beyond 2 asset classes and provides clients with exposure to multiple asset classes that perform across a wide spectrum of economic environments. Thanks for taking the time to listen to the presentation today. We look forward, as always, to discussing other pertinent topics with you all soon. Thank you.